Hi everyone, this is Victor here. Welcome to the Intelligent Investors channel. In this video, I'm going to talk about the 4 major risks of investing in Chinese stocks and whether we should buy more, hold, or stay away from Chinese stocks. As you may already know, the current Chinese regulatory crackdown is impacting all Chinese stocks, especially the largest internet-based Chinese stocks. So for example, ever since Ant Group's IPO was suspended in November last year, Alibaba stock is down 30.39%. Tencent Holdings, the largest internet company in China, is down 27.58% from its recent peak in February this year. DIDI Global, the largest ride-hailing company in China, is down approximately 22.59% from its recent peak. Chinese regulators forced DIDI to remove its apps from the Chinese app stores and restricted DIDI from adding new users because of data collection and cybersecurity issues. The important questions are: what are the major risks of investing in Chinese stocks now? Are Chinese stocks undervalued? Is it a good time to buy Chinese stocks now? Should you hold or should you stay away from Chinese stocks? I will do my best to answer these questions in this video by talking about these topics. First, I will talk about the first major risk: cybersecurity review and data collection issues in China. Second, I will talk about the second major risk: antitrust crackdowns in China. Third, I will talk about the third major risk: China stocks potential delisting in the US. Then I will talk about the fourth major risk: variable interest entity, VIE structure. Then I will talk about what are the key takeaways. Should you buy more Chinese stocks, hold, or stay away from Chinese stocks? If you like this video, make sure to smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and portfolio videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a VIP patron. You will be able to follow all the stocks I'm buying in my portfolio every month, and you will be able to download the latest intrinsic value calculators I use to analyze stocks, so you know when a stock is currently overvalued, fairly valued, or undervalued. The link is in the video description. Take a look, let's start. Before investing in Chinese stocks, I believe it is important to understand the risks. I believe the first major risk now is China's current regulatory crackdowns on cybersecurity issues, data collection, and data security issues. According to this Bloomberg article here, the Cyberspace Administration of China, the country's internet regulator, has proposed stringent new rules on overseas listings. Companies with data on at least 1 million people will be required to undergo a cybersecurity review before they can conduct an IPO abroad. The review will also look into potential national security risks from such IPOs. This means nearly all the Chinese companies wanting to go public overseas will need to go through China's cybersecurity reviews. Recently, right after DiDi's recent IPO, Chinese regulators quickly ordered DiDi to remove its apps from the Chinese app stores and prohibited DiDi from accepting new users. This has caused DiDi stock to drop more than 22.59% from its recent peak. Now, Chinese regulators have put DiDi under cybersecurity reviews. One of the main purposes of China's cybersecurity reviews is to make sure Chinese companies' large amount of user data is secure and stays within China because of national security concerns. This is to make sure China's user data is not accessible by foreign governments such as the US. Personally, I believe DiDi rushed its IPO, knowing it may not be compliant with China's cybersecurity and data collection regulations. According to the Wall Street Journal, DiDi ignored Chinese regulators' suggestion to delay its IPO. This is from CNBC. DiDi had warned in its IPO prospectus that it met with regulators earlier this year, along with several other Chinese internet companies. The ride-hailing company said it might be subject to penalties as regulatory bodies might not be satisfied with the inspection results. According to the prospectus, we cannot assure you that the regulatory authorities will be satisfied with our self-inspection results or that we will not be subject to any penalty with respect to any violations of anti-monopoly, anti-unfair competition, pricing, advertisement, privacy protection, food safety, product quality, tax, and other related laws and regulations. We expect that these areas will receive greater and continued attention and scrutiny from regulators and the general public going forward. All the Chinese companies that are planning to go public overseas and the existing Chinese public companies such as Alibaba, Tencent Holdings, DIDI Global, Meituan, Baidu, JD, and Pinduoduo will likely need to go through China's cybersecurity reviews because of national security risks. Again, China wants to make sure all the tech companies' enormous amount of user data stays within China and is not accessible by foreign governments such as the US. Now, I cannot predict which company Chinese regulators will be targeting next. I think Chinese regulators will crack down on DIDI Global is setting a precedent for Chinese public companies going forward, especially in cybersecurity, data collection, data privacy, and antitrust issues. This means we should expect there will be more cybersecurity reviews going forward and potentially large fines if Chinese regulators find more Chinese companies are not complying with cybersecurity and data collection regulations. I believe the second major risk is the current antitrust crackdown in China. Alibaba was fined $2.75 billion earlier this year for its anti-competitive behaviors, such as 二选一 in Mandarin. This means forcing merchants to choose one between two competing e-commerce platforms. In the past, if you were the merchant and if you wanted to sell on Alibaba's marketplace platforms, you would likely need to have an exclusive agreement with Alibaba and not sell on other e-commerce platforms such as JD and Pinduoduo. Here is another recent case that shows China is blocking the largest Chinese internet companies from anti-competitive behaviors. According to CNBC, China's State Administration for Market Regulation (SAMR), Chinese antitrust regulator, recently blocked Tencent Holdings from merging the two largest video game streaming platforms in China, Huya and Douyu. Tencent has over 1/3 shares in both companies. Huya and Douyu have a combined market share of over 70% in China. Now, to be fair, China's antitrust regulator is not blocking all mergers and acquisitions in China. As far as I know, China is reviewing each case individually from the largest internet companies. For example, according to the Wall Street Journal, China's antitrust regulator recently approved Tencent to acquire Sogou to take it private. Sogou is the third largest search engine in China. It competes with Baidu, which is the largest search engine in China. Tencent Holdings is well known to invest in many startup companies and have substantial investments in many businesses, ranging from mobile gaming, social media, social commerce, e-commerce, music streaming, food delivery, to even ride-hailing service such as DIDI Global. If you look at this Wall Street Journal article here, you can see Tencent Holdings has substantial investments in Pinduoduo, Meituan, JD.com, DIDI, Sea Limited, Epic Games, Activision Blizzard, Snap, Spotify, Universal Music, and Neo. Tencent Holdings also has substantial investments in Tencent Music. All this means is that Tencent's future acquisitions and investments will likely be limited by China's antitrust regulator going forward. Other companies such as Meituan and DiDi already have the largest dominant market shares in their sectors. They have the biggest chance of getting fined by China's antitrust regulator. Personally, I believe all these antitrust probes against the largest internet companies in China are only temporary. In the short term, I believe more Chinese companies, especially the largest Chinese tech companies, will be fined by China's State Administration for Market Regulation (SAMR) for their anti-competitive behaviors and for their past merger and acquisition deals that did not receive approvals from SAMR. Now, in the long term, I don't think these antitrust fines will have a large impact on these companies such as Alibaba and Tencent Holdings that already have large dominant market shares in China. I believe the third major risk is China stocks' potential delisting from the US stock exchange. First, the US Holding Foreign Companies Accountable Act, HFCA Act, may delist many Chinese stocks within the next 3 years. According to the US Congress website here, the HFCA Act will require all Chinese public companies listed on the US stock exchange to declare that they are not owned or controlled by the Chinese government. Here's the important part. The HFCA Act requires the Chinese public companies to be delisted from the US stock exchange and even over the counter if the Chinese companies cannot be audited by the Public Company Accounting Oversight Board, PCAOB, for 3 consecutive years. As of now, PCAOB cannot audit almost all the Chinese companies listed on the US stock exchange because China's regulations prevent foreign regulators such as the US PCAOB from auditing Chinese public companies due to China's national security concerns. According to US China Economic and Security Review Commission here, there were 248 Chinese companies listed on US stock exchange with a total market cap of 2.1 trillion as of May 5th, 2021. There were 8 national level Chinese state-owned enterprises listed on the 3 major US exchange. In my opinion, I believe it would not make sense if the US decides to delist all Chinese public companies if they cannot be audited by the PCAOB for 3 consecutive years. This will have a huge economic impact on US investors and the overall US stock market. Now, this is only my speculation. I believe the US and Chinese regulators will still allow the largest Chinese tech companies to stay on the US stock exchange or allow the US PCAOB to co-audit Chinese public companies within a certain limits that do not compromise China's national securities. I want to show you this article here. President Joe Biden has signed an executive order to ban US entities, meaning US investors, from investing in more than 59 Chinese companies that are related to Chinese military, defense, and surveillance technology. If you look at this list, you can see all these Chinese companies that are being banned. Many of these companies are likely Chinese state-owned enterprises. Now, according to this article, this list of 59 Chinese companies that are banned will continue to be updated by the Treasury Department on a rolling basis. This means the list of Chinese companies being banned will likely increase going forward. Some of the well-known Chinese companies that were already delisted include China Unicom, China Telecom, China Mobile, CNOOC Limited, and CMIC. Personally, I believe the Chinese state-owned enterprises and Chinese companies related to defense and surveillance technology sectors have the biggest chance of getting delisted. I will stay away from them. I believe the fourth major risk is the variable interest entity VIE structure that is used by most Chinese companies listed on the US stock exchange. Here's the important part you want to know. China restricts foreign ownerships and investments in industries such as the internet, media, telecommunication, and education. Chinese companies such as Alibaba, JD, Pinduoduo, DIDI Global, Baidu, and Tencent Holdings seeking foreign investments have been using variable interest entity VIE to go around China's restrictions on foreign investments. Variable interest entity VIE structures are essentially shell companies in foreign jurisdictions such as the Cayman Islands. Now, China's Securities Regulatory Commission is looking to close this loophole. According to this article here, US listings of Chinese companies using VIEs, which includes such big names as Alibaba Group Holding, Pinduoduo, and JD.com, are worth a total of 1.6 trillion. Also, according to this article here, VIEs own no real assets and have no legal recourse should Chinese decide to void the whole situation, meaning VIE structures or the Chinese parent company decide to move assets elsewhere. I believe the biggest risk is that Chinese regulators could deem variable interest entity VIE structures illegal or ban VIEs altogether. Another scenario is that Chinese regulators will likely require all public Chinese companies to seek approvals before using variable interest entity VIE structures as a workaround to go public in the US. I believe banning VIEs altogether, in my opinion, will not make economic sense to China in the global capital market. If China suddenly deems VIE structures illegal or bans VIEs, it will have a huge impact on Chinese stocks, especially the ones that are already listed overseas in the US, including Alibaba, JD.com, Pinduoduo, Baidu, and DiDi. Personally, I think the chance of this happening is low because foreign investors around the world will stay away from investing in Chinese stocks going forward. Chinese companies will no longer be able to raise capital overseas. This will force all Chinese companies to only be able to raise capital either in Hong Kong or in China. Now, I believe a much likely scenario is that all Chinese public companies that are seeking to raise capital overseas in the US and all existing Chinese public companies such as Alibaba, DIDI Global, and Tencent Holdings that are already using VIE structures will need approvals from Chinese regulators going forward. So what are the key takeaways? And should you buy more Chinese stocks, hold, or stay away from Chinese stocks? I think it depends. As of now, I believe many Chinese stocks are undervalued because of the regulatory risk I talk about in this video. For example, the CraneShares CSI China Internet ETF that focuses on China-based internet companies is down 39.52% at the time of making this video. In comparison, the Nasdaq index was down 30% during the peak of the pandemic period in March 2020. If we consider all the regulatory risk I talk about in this video, I still believe it's more prudent to stay away from Chinese stocks if you have a small portfolio or if you are just starting to invest with a small amount of money. However, if you have a larger portfolio and if you already have existing Chinese stocks, I believe it's more prudent to underweight Chinese stocks to reduce risk going forward. For example, I have 578,000 in this growth stock portfolio now. I have long positions in Alibaba, JD.com, Tencent Holdings, and Pinduoduo. If I add all of them together, they are less than 5% of my growth stock portfolio, so I'm not too worried about them. I am planning to hold them for the long term. To reduce risk, I intend to underweight Chinese stocks, no more than 5% of my growth stock portfolio. I will always overweight US stocks because I like US-based tech companies the most. My portfolio strategy is to always invest in the best US companies for the long term that have increased earnings and increasing economic modes each year. Now, all of these are only my opinions and my analysis based on my research. They are not financial advice. I always say this, make sure you always do your research and do your extra due diligence first. If you like this video, make sure to smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and portfolio videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a VIP patron. You'll be able to follow all the stocks I'm buying every month, and you'll be able to download the latest intrinsic value calculators I use to analyze stocks, so you will know when a stock is currently overvalued, fairly valued, or undervalued. Thank you for watching this video. This is Victor from the Intelligent Investor channel, and I will see you in my next video.